Welcome to this Killik Explains finance video. This week, the multiple expansion trap for equity investors. What is it and why is it a trap? Well, I'm not the only one talking about it, and you get different opinions at the moment depending on your view of the market. So, at BlackRock, we've got comments like slower growth is inconsistent with rapid multiple expansion. So there it is, that phrase. What is it they are talking about, and is it good or bad news? That's a kind of negative view, if you like. A more positive one would be PE multiples north of 20 in the US, near 20 in the UK. You might say, give plenty of room for multiple expansion. And there it is again. So whatever this thing is, it's causing people to talk about it, and I reckon there's a potential danger sign here for equity investors. You've got to keep an eye on what's going on. So let's take a look at it. It's based on the PE ratio. So very quick refresher on PE ratios. The PE ratio, one of the most widely quoted ratios in the market, expresses basically the current share price as a multiple of 1 year's earnings per share, either historic or a forecast. And it gives you a number. And that number represents, very roughly, what investors think the share is worth in terms of earnings per share. Basically a guide to is the share cheap or expensive. How can I say that kind of thing? Well, if we were to look at a quick example, if the PE ratio for a company is 10, that's mechanically because someone's just calculated it as 10. If earnings don't change, you could say, roughly speaking, as a rule of thumb, you're prepared to wait 10 years to get your money back. And you might say, maybe I am. But what if the PE ratio is only 5? Then, mechanically, you are saying at the current rate of earnings, you're prepared to wait just 5 years to get your money back. Or it'll only take you 5 years to get your money back, and that's sounding like quite good news. Or maybe we've got a bit of a free lunch there, or have we? And then at a PE ratio of 100, and we've seen technology stocks go there in the past quite often, if earnings don't change, you'd be happy to wait 100 years to get your money back. Well, that doesn't sound very likely, does it? So maybe we're saying something else here. Maybe what we're saying is that low PE ratios could reflect low growth prospects for earnings, even declining earnings, all right, or a bargain. Bargain hunters like low PE stocks, and it's down to you. If I could give you a definitive answer, then basically I wouldn't be standing here, I'd be in the Bahamas. All right, so it's down to judgment as to what these PE ratios actually reflect. But a more toppy PE ratio, like 100, would be considered fairly high, given the FTSE 100 is trading around 20 at the time this video was made, so 100's high. Either that's saying, fantastic, get in because this company's earnings are going to rocket, or it's got warning signs written all over it. Way too expensive in earnings terms. So, what's this got to do with multiple expansion? Well, let's take a look at a company with a PE ratio of 10 where the share price has moved from £1 to £1.20. Why is that happening? Well, I'm going to suggest just two explanations here. One is rapid earnings growth or decent earnings growth. That's pushed the share price up. But there is another explanation, this thing called multiple expansion. It could be that the market is pricing in further expectations of growth. Now, mechanically, how would that work? Imagine you've got a company with a PE multiple of 10, and that's based on simply dividing the current share price, very easy number, of £1 by earnings per share of 10p. That over that equals that. You may notice something else, by the way, it's not rocket science this, that if you were to multiply the PE multiple by earnings per share, you get the share price, and that will matter in just one moment. Now, supposing earnings per share moves up to 12p. Great, the company's doing better, it's making more profit per share. If the PE multiple stays at 10, the share price will mechanically rise to £1.20 because the share price, I just said, is that times that. All right, so the share price has moved up. And actually, why not? The movement in the share price, assuming we believe the director's earnings figure, that's something for another video, assuming we do, the movement in the share price is down to better earnings. So why wouldn't the share price go up? But maybe it's down to something else. So, PE multiple 10, earnings per share 10p, share price £1. Now watch what I do on the right-hand side. This time, earnings per share stays at 10p, PE multiple rises to 12, and that generates that times that, £1.20. So the share price has moved up, but for a different reason. This is not necessarily because we're seeing earnings coming through. This is because the market has priced in higher expectations in the future. And the point is, some cynics would say, the first reason earnings changing is meat and drink, if you like. That's proper underlying earnings growth. This can get frothy. This could be froth. This is market expectations, harder to formulise and sort of distill, if you like. So that's the danger. The takeaways from this are that share prices can be driven by actual earnings growth or multiple expansion, or a combination of the two. Keep an eye on it, i.e. the relationship between earnings and the PE multiple. On the left, good news if you like, very simple analysis would be static and falling PEs and high growth potential. That would bring the bargain hunters out potentially. And on the right, and some people are saying, are we there at the moment? Well, that's for a debate for another video, but high expanding PEs and static or falling growth potential. In other words, the PE multiple needs to keep alongside the pace of earnings growth in the real world. And that's the message from this video. So, lots of ground covered there. If you want to see more on putting these two sort of facts together, PE multiples and earnings growth, you could watch my video on the PEG ratio at killikexplains.com. If you've got any questions on what is a fairly big topic, do feel free to email me at the usual place, editor@killik.com.